Welcome to the Meb Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got a fun episode today. We're joined by Kim Flynn, president of XA Investments, where she helps provide access to alts and vehicles that are tailored to meet the needs of individual investors. We've been diving into this topic a little bit recently. Before her role, she was head of product development for Nuveen Investments, global structured products group. Kim is one of the most knowledgeable people on the democratization of alt investments, growth of the interval fund market. Kim, welcome to the show.
Thank you, Meb, for having me.
That was a wordful in the beginning, but you are now currently at XA. For those who don't know what XA is, what is XA?
We are focused entirely on alternatives and the intersection of retail investment into private markets. And to make these vehicles available, we're basically building SEC-registered closed-end funds, listed closed-end funds, interval funds, because they can house illiquid assets. There's a lot of sort of innovative products that have come before interval funds, things like non-listed REITs and non-listed BDCs. And this is just sort of the latest advent of product innovation, but you can put pretty much anything into an interval fund. You can put private equity, you can put infrastructure, you can put hedge fund strategies. You're not limited in the way that REITs and BDCs are fairly specific to real estate in the case of REITs and private credit in the case of BDCs.
Well, it's definitely a hot topic. My buddy Ben Johnson over at Morningstar had a tweet or LinkedIn, something this morning that I saw that caught my eye. And he said, the interval funds are coming. There have been more interval funds launched in the past 5 years than in the preceding 27. And 2025 is already a record year for new launches. And here we are, not even halfway through. Born in 1993, like US ETFs, the wrapper lends itself well to packaging private assets for a broader audience. So maybe just give us an overview. I don't know that we've really gotten too deep on interval funds thus far on the show.
Legally speaking, they are continuously offered non-listed closed-end funds. So it's a sort of a misnomer, which is why the industry has taken to calling them interval funds. Interval fund, that naming is just a label. It's not actually like a legal construct. And so that just means that like a mutual fund, they are continuously offered and they're perpetual in nature. So they're going to grow over time. Otherwise, they don't share that many similarities with mutual funds or ETFs because in a SEC-registered closed-end fund, or in this case, we're speaking about interval funds, you can have 100% allocated to illiquid investments without any limit there. That really opens up a lot of these private market strategies that would otherwise be put to market in a private fund structure. But wealth managers really like interval funds because they get you to a 1099, they get you to some form of interim liquidity. And frankly, to the extent that the private credit market, you asked about what's the hottest area, it's been private credit. 80 of the 280 funds are private credit. Most of those are daily NAV. So that means they can be daily in, but they're not daily out the way a mutual fund works. They're typically quarterly exit, and it's limited to 5% of net assets. So that's why these interval funds are often, referred to as semi-liquid evergreen products. But you have to be, thoughtful about liquidity because if you want liquidity, other people might want liquidity too. So you're subject to proration at that quarterly liquidity window. And so you might be waiting multiple quarters to get liquidity. If it's an 08 or 09, you might be waiting more than a few quarters. So you have to bear that in mind. The structure is a good fit for these illiquid assets like private equity and infrastructure. But unless you want a lot of cash drag, these funds, they have a low liquidity profile for a reason, so they need to be structured in an appropriate way.
We'll stick on interval funds for a bit, but for the people who say, well, look, I know what closed-end funds are, maybe just tell us real quick the difference between the two. Closed-end funds, I remember when I first started interested in markets, closed-end funds. I used to read the Herzfeld closed-end fund report, and people talked about them, and closed-end fund connect, which I think was Nuveen product at some point, and I still go there. Say, wow, some of these are trading at discounts. So maybe just explain real quick what a closed-end fund is, and then talk about the difference between the two.
Yeah. So a listed closed-end fund is going to have both a price and a net asset value. An interval fund just has a NAV. It doesn't have a separate trading price because it's not listed on a stock exchange. Listed closed-end funds, they get a bad rap because many of them trade at discounts to their NAV. So because you have a price that's distinct from a NAV, listed closed-end funds are going to trade, and they trade on price, and that depends on market demand for that security. Most of the listed closed-end funds, like if you look, I worked at Nuveen, the heritage there was municipal bonds. We had a lot of muni bond closed-end funds. So listed closed-end funds tend to be yield oriented because they trade on yield. An interval fund is more like a mutual fund. It only has a NAV. It doesn't have a separate price. So it can't trade at a premium or discount because there's only one stated price, which is the NAV of the fund. And so you get in and out of an interval fund at NAV. There are plenty of interval funds that are still monthly NAV. And so then they're going to bring people in once a month. But the largest segment of the market is private credit because that's been so popular in the last few years. And I think that a lot of it is that it's been easier for financial advisors to buy daily NAV private credit because you can ticket through the mutual fund ticketing platform, which is the NSCC FundServe platform. And you use a 5-letter symbol ticker, to buy an interval fund the same way you would buy a mutual fund. So in that sense, wealth managers, they're accustomed. They know how to buy a mutual fund. They know how to buy a daily NAV interval fund. Now, to the extent that the fund isn't daily NAV, you do have subscription documents, which means you have client signatures, which for some advisors, that's not a problem. For others, they're not going to mess around with subdocs and whatnot. So the growth of the market, there's now 280 funds. There's a wide variety of strategies, some of which are daily NAV. There's a bunch that are monthly and quarterly NAV. It really just depends. Assets such as infrastructure, private equity, they're longer duration, longer time horizon. You're not going to have a daily NAV on private equity. It's hard to get to that NAV. You wouldn't want to trade on that NAV. You'd have to have comfort. And this gets, there's auditors involved in making sure your valuation policies and procedures are appropriate. But that's why things like private equity or infrastructure tend to be monthly NAV. Some of them, for that reason, are also structured as tender offer funds. Don't be confused. Interval and tender offer funds are basically just sister fund structures. Once again, these are just labels. Legally speaking, they're both types of non-listed closed-end funds, which means they only have a NAV. There's no premium or discount like you have with a listed closed-end fund. There's just, when structuring these funds, depending on the asset class, you might end up with a tender offer fund than an interval fund.
Now that you have this ascendant rise in the interval structure, why does the closed-end fund still exist? Because, as I look at it, I'm trying to think of all of the ideas and issues. And is it killing the closed-end fund, first of all? Maybe it's not. And then second is, will it? Because to me, it seems like discount to NAV or premium is really only interesting to like the hedge funds and individual investors or people who are like trying to trade that. But for the vast majority of people that are buying at issuance or buying it, they don't want something that's going to go down 10, 20, 30% to NAV. And then theoretically, a lot of the assets seemingly would just be much better in an interval fund structure anyway. So is change happening, or is closed-end fund dead?
So as a longtime advocate for listed closed-end funds, in many ways, it's a superior product structure because you're never a forced seller. And with private market assets, you don't want to be a forced seller. So the fact that a listed closed-end fund might trade at a discount because somebody needs to sell the fund at maybe an inopportune time, at least it's a liquidity function that's available. Now, the US listed closed-end fund market is largely traditional investment strategies, things that you could buy in a mutual fund or an ETF. So what I would argue is that ETFs have made it very challenging for new listed closed-end fund IPOs, as you would expect, right? With the innovation in ETFs, the world doesn't need another senior loan fund or a high yield bond fund. So it's incumbent upon the listed closed-end fund market to innovate, and they should look across the pond to London. London listed funds, they work in a similar way as US listed closed-end funds. But the London market shifted 10 years ago to being primarily private markets and alternatives, and actually a lot more niche exposure. Now, the London market will still go to a discount. I don't have a problem with the discount if that's where the market needs to clear. So I think part of the beef that people have with BREIT and BCRED, some of these large REITs and BDCs, is that they're questioning valuations and they want more liquidity than the product actually offers. So I think the world is better if we have London listed funds or US listed funds that have alternative investment exposures. There's a reason we don't in the US market. So it's really about underwriter preferences. You know, these listed closed-end funds get issued by Morgan, Merrill, UBS, Wells Fargo. And they historically were sold just in those systems. Eventually, the shares migrate into other people's hands. But right now, the closed-end fund market is completely closed. So there's room for innovation. Bill Ackman tried to bring a listed closed-end fund last summer with his Pershing Square. So that would have been exciting. There was an unforced error that was made on the marketing side, unfortunately. So that fund didn't get done.
Didn't he send out an email to everyone or totally disclose?
Yeah, I think the email was sent to institutional investors, and then the SEC forced it to become a filing. So then it was publicly made available. And then there was a cooling off period anytime that. So the SEC is here to protect the retail shareholders. And so that was what was required. But the cooling off period with any closed-end fund IPO, if you move past the end of production month for ticketing, it's going to be a problem for the deal. So anyway, that deal was a little bit smaller than I think Pershing Square expected. It was probably coming in, about 1.5 billion. I think they had expectations of closer to 5 billion. So that didn't get done.
I said on Twitter, I don't understand why he just wouldn't do an interval fund or an ETF. I was like, if he's doing public stuff, why wouldn't he just do an ETF? And then if he's doing a bunch of private stuff that he's worried about or wants to do lockup, why wouldn't he do an interval fund? Because if you look at, so listeners, in our very first book, many moons ago, Ivy Portfolio, we actually wrote an entire chapter on closed-end funds, but also the foreign listed hedge funds that traded in Europe. So during times of stress, Greenlight, or Third Point in particular, had one, I think in 08, 09, that went to a 50% discount. And you have these times, Pershing Square has these funds that trade in Europe that consistently trade at a 30% discount to NAV. And so in my head, I'm like, why would he want to launch a closed-end fund other than just has a audience that may raise a bunch of money? I was like, why wouldn't you do an interval fund or an ETF?
I agree with you. But the reason is, think about all of the publicly traded alternative asset managers, Blackstone, Apollo, you name it. They all want permanent capital because the enterprise value of their organization is much, much higher to the extent they have permanent capital. So it's what you hear them speak about in their quarterly earnings calls. Listed closed-end funds are permanent capital. Listed BDCs are permanent capital. An interval fund is not permanent capital. It's evergreen, which is good. It's sticky, which is good. But an interval fund can go to zero in less than 4 years. So that's why I think for Bill Ackman, you're right. I mean, his London listed fund was trading at a 20% discount when he tried to it's the same strategy, similar portfolio. So I don't know why he thought the US listed fund, usually US listed closed-end funds are designed for yield, and that fund did not have any yield. And that is what helps these things trade better, because there is a whole audience, income buyers, retirees, who like yield. And that's why listed closed-end funds have attracted those types of buyers. I think there's room for innovation to the extent that we could create alternative interval fund like products in the listed space. Absolutely. But I think there are some selfish motivations in terms of the demand right now is on the interval fund side. They're seemingly popular. There's definitely some naysayers coming out of the woodwork, though. I think concerns about valuation, concerns about secondaries. Secondaries are becoming a big part of deployment of private equity capital, which, once again, if you're buying secondaries, the question is, how should those be valued at purchase? How should those be valued? Are you going to mark up those securities? When are you going to mark up those securities? So there's a lot of really good questions that some of these, doubting Thomases have about interval funds. We researched the whole market. The market is actually fairly healthy. We are seeing redemptions out of real estate funds. That's no surprise. We've seen massive redemptions out of B-REIT and other non-listed REITs over the last 3 years. So I think that there's plenty of room for concern and question, but we're actually seeing a lot of positive signs of managers that are up in quality in terms of experience, and the institutional integrity of the products being built is very high. The only worry I actually have right now is about some of these public private mixes, because if you're mixing public securities with private securities, you're going to dilute the returns potentially, and you might also confuse people as to what should they expect from a fund that's a mix of public and private. I think for a lot of financial advisors, they already have their public securities allocations too. So I think to the extent that they're looking for private market exposure, they're not going to want a lot of public securities sitting next to it in the same fund, at least.
Yeah, we started to go down. By the way, listeners, if anyone wants to value our company at what Pershing Square got valued at, we need to find these venture capitalists. I think they got valued at 50% of current assets. So good news, listeners. Cambria is now a unicorn, right? Which I don't think is going to be the valuation anyone's going to give us. But I said, good for Bill, be able to raise money at those. But I think you're right. The permanent capital was really the carrot that I think is dangled there. We went down the interval fund rabbit hole a little bit last fall because there's 3 ideas that we really like. One of the problems I have being an ETF issuer is we often see ETFs launch where in my head I look at it and I'm like, just because you can launch something doesn't mean you should. And I look at a lot of these very illiquid private things that people, for some unknown reason to me, are just wanting to stuff into a very publicly traded structure with liquidity. And I kind of shake my head and I'm saying, why are you trying to do this? And do you have any thoughts on kind of that topic? It seems like such a better home just to be in an interval fund or even a closed-end fund for a lot of these private assets. You agree, disagree?
I agree. We actually were skeptical that the Apollo State Street ETF, it seemed like a lot of it was just headline grabbing, lacking substance, if you will. I've seen it with the ETFs where it's been a small part. We also saw it in mutual funds and some closed-end funds because there's limitations. You're not going to get anywhere close to your 15% limit on illiquids if you're managing a mutual fund or an ETF appropriately. So that's why, to me, it's gimmicky because it's also not going to move the needle on performance. We saw that. The other thing that we've seen recently is that Blackstone put out an announcement, which was like an announcement about nothing with the Wellington Vanguard, sort of tie-in that they announced. And I spoke with Jason Zweig at the Wall Street Journal, and he was like, it's basically sunshine and rainbows when Blackstone and Wellington and Vanguard come together and announce something. Then what happened is they filed, subsequent to that big press announcement, they did file the prospectus with the SEC so we could actually look under the hood and see what it is. And it's Wellington serving as an advisor, and they're allocating to existing Vanguard products and existing Blackstone products. So for Blackstone, this is just a way to get a feeder from Wellington into B-Cred and B-REIT. Well, no kidding. Why wouldn't they be excited about that? Blackstone just wants to scale their massively scaled products, right? It's just another source of flow for them. So there's not really anything innovative or unique about it. And I think Jason Zweig was right to be skeptical because a lot of this catches advisors' eyes. And then you look at it and you're like, this isn't a great product. The only thing I'll say is they are trying to go further down market. I think there's a need for that in some ways. There's plenty of people who don't have wealth managers. Another avenue of innovation is some of the direct to consumer platforms like SoFi, or trying to make interval funds available for people who manage their own investments. Right now, if you manage your own retirement accounts like I do, you can't buy an interval fund on Fidelity if you don't have a wealth manager.
Why is that, by the way? I didn't know that. Why is that?
Because there's no legal reason that Fidelity and Schwab don't offer. I think that, first of all, there hasn't been the demand for it. If there was the demand and everybody was asking for it, we'll get to that point. It's kind of like your friend at Morningstar. We've been researching this space for 9 years. Early on, there was not much demand for our research, but now Morningstar is getting the calls. There is more demand for information on interval and tender funds. I think we'll get to that point with Fidelity and Schwab. Meanwhile, Fidelity and Schwab are building proprietary interval funds, right? So they've got to build their proprietary funds before they onboard a bunch of other third-party manager funds, right? So I actually think that Schwab and Fidelity are playing catch-up on the proprietary fund builds. Now, Fidelity now has a couple that they've launched, and there's a couple of them in production now. Schwab, I think, is going to have to play more of a catch-up, but they're not going to make a whole array of interval funds and tender funds available, a supermarket approach, if they haven't yet built their own proprietary funds, which I think they're working on.
Talk to us a little bit about, you guys have an interval fund index. What is that tracking? And maybe tell us a little bit about kind of how you guys think about that.
We do. Thank you. We launched it in April of this year. We'd actually sat on it for about 2 years. We built it at that time 2 years ago. And part of what happened is the idea was to bring transparency and help people track, the growth of the market. It's a bit of a barometer for the whole interval fund marketplace. It's a mix of different asset classes. So for multi-strat funds, they could use it as a performance benchmark. And we've talked with a few fund sponsors that do have multi-strat. But if you're a private credit manager, you're not going to benchmark to the interval fund index broadly. We will be launching a credit sub-index. That's the biggest category of the market, so it makes sense for us to do that. But for us, we don't make any money off of this. This is just a way for us to further educate the market. And we thought it was helpful to codify the rules. Now, the criteria to be included, you do have to be a daily NAV, because otherwise, we can't create an index to the extent that, so there are funds that are left out of this index. If you have a monthly or quarterly NAV, you can't be included. But the index does have 77 constituents, so it's a large subset. Funds that have a 1-year track record that have more than 100 million of assets, and it's going to grow. Cliffwater is the market leader. They're the largest holding in that index, followed by firms like Carlyle and Blue Rock and others who have large scaled funds. So it is market cap weighted based on the assets in the fund.
I feel like when you were talking about crossover a little bit, did Coatue ever launch? Weren't they doing an interval fund, or did I imagine that?
No, they did, and with a lot of attention. But so Coatue, that fund is a mix of public and private securities. I believe it's a tender offer fund, not an interval fund. But I think there's a lot of competitors, firms that are looking at what Coatue did. Vista Equity launched a retail 3C7 fund called Vista One. And so there's a lot of other tech, software-focused private equity shops that are saying, hey, that's interesting. Vista Equity did very well out of the gate raising capital. And I think they ultimately capped capital raising. They'll open it back up. But the Vista Equity product launched primarily in the wires, whereas most interval funds actually launched in the RIA channel. Morgan Stanley is leading in terms of the number of funds available on their platform. But there is a long investment in operational due diligence for funds to get added. It's not just the wires, regional broker-dealers, other firms from Ameriprise to Raymond James, they're all adding interval funds, but they're treating most interval funds to a diligence process that's similar to how they evaluate private funds and BDCs. So I think for advisors in those firms, that's a good thing, but it can be a slow process.
Talk to us a little bit about y'all's strategies. What are you guys focused on at XA currently? And then we can kind of get into on the horizon as well.
Yeah, part of the reason why I love to defend listed closed-end funds is we actually have two listed closed-end funds. And so that was the origin of our business when we launched 9 years ago. Everything we do is in partnership with asset managers, sub-advisors. So we have single manager, single strategy. We have two private credit funds and we have one hedged equity fund, and they're all sub-advised. And part of the reason that we do the research that we do, or the reason I'm speaking with you, is because we actually, being a smaller firm, we love to build product. And we actually, 5 years ago, created a consulting practice where we actually assist GPs, other alternative boutiques, on how to launch an interval fund. And so while I love talking about my proprietary funds, as you know, from a compliance perspective, it's hard for me to tout them publicly. So it's better for me to talk about the advantages of, for shareholders, the merits of the interval fund structure, tender offer fund structure. I love listed closed-end funds, but the two funds that I have are income-oriented products, and they're closed because they're listed. And so right now, we're not offering those funds publicly, because they're traded on the exchange. We do have an interval fund that we launched inside of Wells Fargo in November. It's a CLO debt focused fund. So that fund is doing what all, new interval funds do, which is growing and working to scale. And every new fund has the same chicken and egg problem, because you've got to open up Schwab, you've got to open up Fidelity and expand platform availability. And interval funds have a unique challenge that mutual funds and ETFs don't. It's actually because of the automation and the technology that's been put into the onboarding of ETFs and mutual funds. It's actually pretty easy to get added at Schwab or Fidelity or some of these platforms. With interval funds, it's still very much a manual process. And so Schwab and Fidelity, there's demand indications that you have to meet. And frankly, so it's north of 50 million of demand, and it typically takes about 6 months to get onboarded at Schwab and Fidelity. So every new interval fund has to go through that process of rounding up investors who clear through those platforms just to make the fund available. And so it's just not as easy as launching a new mutual fund or ETF. I think the industry will catch up, but there has not yet been that technology development to facilitate it.
I mentioned earlier, there's a couple of areas I would love to see more interval funds. Would love to be an allocator. I don't know if that means they would be popular at all, because we often have ideas that I don't think anybody else wants. One of which to me was always farmland investing. And there's been a few, I feel like a couple shops that have done a little in farmland, but usually it's as a chunk of the real asset exposure or a chunk of a overall fund. Is that an area that's kind of just forgotten? Because it feels like it could, check that income inbox perhaps, or real asset exposure.
I don't know if you've been eavesdropping on my conversations with my husband, but he's like, you got to go build a farmland fund. We did actually. And the reason he brings it up is we worked on a project in London to launch a farmland focused London listed fund. And at the time that fund was launching, the Queen died and FX rates went upside down. And so that product never got launched. And it was a great, great diversified farmland fund. And so we have a white paper on our website if you want to read more about farmland investing. I'm a big believer. I agree with you. There's not a dedicated farmland fund. There are a few farmland REITs if you're interested in farmland REITs. But in the interval and tender fund space, it's just like a small allocation, like Versus has a real asset product where they do invest heavily into farmland, but it only equates to 15% or less of that real assets fund. So I do think that investors could benefit from a diversified farmland fund. We've talked with a number of managers. It's always interesting. There's a few fun facts about farmland investing, since you've hit on one of my favorite topics. But in the US, Bill Gates, one of Warren Buffett's sons, I'm just naming some of the biggest farmland investors in the US. But so Bill Gates gets a lot of headlines, but do you know who's actually the biggest farmland investor in the US? It's not a person, but an institution. Can you guess?
I feel like I should know this. Let me think for a second.
There's a religious affiliation.
Oh, is it the Mormons?
Yeah, the Mormons.
Yeah.
So the Mormons own the most farmland and ranch land across the US than any other, than Bill Gates or Warren Buffett's son. And so there's not that many like institutional pedigree asset managers. There's a handful, and I feel like we've talked to many of them, and they're growing in size, they're growing in their track records. And so I think there's some really interesting things to be done. It's an interesting time in terms of if you're the son of a farmer in Illinois, where I live, and you don't want to farm for a living, there's this generational wealth transfer that's happening right now between baby boomers and their kids who are in their, 30s or 40s. And the other thing that's happening too is that it's with technology in farm investing, harvesting, it's a lot more expensive to run a farm. So there've been a lot of consolidation of smaller farms into larger farms. And so that lends itself to more institutional investing in farmland. So I think it's a good idea. Hopefully we'll see more of
Yeah,
it.
well, when you want to team up on this, let me know. We've done a bunch on this podcast. Listeners are probably sick of me doing farmland episodes, but I finally sold my last piece of farmland last year in Kansas. Direct ownership is a huge pain in the booty, but I love that as an asset class. And as you mentioned, there's only a couple of REITs. We've had Gladstone on the podcast in years past, and other than a couple private funds, which are choices, you can do some of the new direct offerings. But I would love to see a couple interval funds. I think that would be a perfect solution for this. A couple other things, listeners. So we'll put Kim's white paper on the website on farmland investing, reframing farmland as an investment. There's some other good papers from the Knowledge Bank we'll include. There's also a great magazine where you can sign up for it. It might be free. I think it's called The Land Report. And there's a couple of these where you can subscribe, and it's like maybe it's monthly, maybe it's quarterly, but it's really good. One, just for like farmland porn or just ranch, type of stories and profiles. But also it'll be like, hey, here's the 10 biggest ranch sales of this past year, 10 biggest private owners, 10 big, on and on. And it's just a really cool, if you go to landreport.com, it's an interesting website too. Anyway, check it out. We'll put it in the show note links. I have a whole bunch of things that if we ever get to 10 billion is on my list of to do that we want to do. One of the struggles when we went down the interval fund route as an ETF issuer is that, oh man, there's three problems for me. One, it's harder. So you mentioned the platforms, having to get to size, having to get to the approvals of kind of the blessings of certain plumbing that's just a little different than the ETF. Two, you got to do stuff like audits on or pricing of the private assets. And then three, it's more expensive to get started than, say, an ETF. And so we want to do it, but just maybe not yet. Second area after farmland that we think is ripe for opportunity is you mentioned a lot of interest in private credit and traditionally real estate. There's some private equity and venture capital, but it's almost all really late stage. Like it's like, hey, you want access to SpaceX and Anduril or companies that are 100 or 300 billion. I think it'd be really interesting to have sort of an early stage venture capital style fund that's actually owning Series A type of companies. Anything like that? Or do you think anyone would like that?
There's nothing like that in the London listed market. There is, because there's a preference there for seed or, A round. In the US, I think we're probably a few years away from it. That doesn't mean that it shouldn't be tried. I think that venture capital has unique issues. Capacity constraints is one. Fees is another, because if you're creating that much value, you're going to want to charge 2 and 20 or maybe higher. And I think that a lot of the name brand venture capital firms are not going to enter the interval or tender fund space directly because their capacity is probably already spoken for. There are a few funds where it's a smidge of what they're doing, like Fairway Capital out of Chicago. That was some people who left Adams Street. So it's a fund of funds. So I think there could be an avenue. There's still plenty of people who want that SpaceX exposure. The Private Shares Fund is one. The Primark Makita Fund. Those get to a daily NAV, so it's easier for wealth managers. Stepstone, one of their private equity funds, just switched to a daily NAV. But there's only a small subset of those private equity funds. Right now, most of the private equity funds are doing secondaries and co-invests. I agree with you, though, from a long-term value perspective, maybe they should introduce more venture into the mix. But you're right, we're not seeing it. There have been a couple of funds that have come and tried, but for various reasons it hasn't worked. But like Kathy Wood with her ARC Venture Fund, it's now growing. It's north of 100 million, but it's been very slow. She's not known for making venture investments, so that's a logical problem that they have there. They're also not directly marketing or selling that product. They've got, I think, third parties helping. There was a firm out of California called Sweater Cashmere. That was a direct to consumer sort of play, and they were going to invest in early stage venture, but it hasn't been able to attract capital. So anything direct to consumer, the only firm that's been able to raise capital is Yield Street and another firm called Fundrise. But other than that, this is largely a wealth manager driven sale and product push. Meb, I love where you're going. Most people they call me up and they tell me where the white space is in the market. And I'm like, well, why would I tell you? Why would I tell you where there's white space in the market? You'd have to pay me a lot for me to tell you. But you just hit on two areas. So this is the hot tip of the day. Farmland is definitely white space. Venture is definitely white space. I'll give you a third, which is we haven't yet seen sector. We're starting to see some tech focused with Vista and Co2. But healthcare, there's certain other sector specific that could be interesting, public, private, or just private. So we'll probably see that as the market expands.
We have plenty of crazy ideas, and as evidenced by our lineup that other people, I like to say, have not come around to yet. We got ideas that one of which is an interval fund, and you mentioned Jason Zweig. I talked to him about this years ago. And I think interval fund is the only structure that could accomplish this, which is basically, I want to do an aggressive allocation fund for very low fees. So I say, okay, that's great. We have some of those in ETF form already. Why do you need an interval fund for this? Because the biggest struggle I have as an investor, and this is true for institutions too. I see this with financial advisors behave just as poorly. Institutional shops like CalPERS behave just as poorly as individuals. So this isn't just a retail phenomenon, but basically chasing performance, whatever is going up over the last couple of years. Nowadays, it's last couple of months, and trying to get the young investors say, hey, look, I really want to focus on compounding, not this month, this week, this quarter, but this year, this decade, 2 decades, 3 decades. And so we said, we kind of half jokingly titled this the Forever Fund. And it's an interval fund idea where you get a great allocation, super low cost, but you put up some of those gates. But if you withdraw within the first, 5-10 years, there's essentially a sales load, right? But
redemption fee.
There's a redemption fee, just like Vanguard does, but a little longer to try to get you to stay. But the kicker would be that redemption fee wouldn't go to the management company, it would go to the shareholders. And so you would get sort of a poor behavior dividend.
It's a commitment device, effectively.
Yeah. But I love this idea because it's a bit of a, it's not permanent capital, but it's an idea that hopefully would keep people focused on the whole point of this, which is how to compound for 10, 20, 30, 40, 50, 100 years and not get in the way. Because getting in the way of the bad behavior, as we've seen time again, is often what derails people.
Well, I like that because it's honest and it's direct, and many of the fund sponsors are just dancing around the topic as opposed to putting it front and center and saying, we want to reward people who have a long-term investment horizon. So,
yeah, it goes back to the old school coffee can portfolio of many decades ago, or the concept was you buy a stock or you buy a fund, just put it away, like forget about it, put it in the lockbox, come back. The gamification of markets and sports and young people wanting to trade everything is the exact opposite of this. And so I'm trying to figure it out, but one day. So as Kim looks out on the horizon, if there's some financial advisor listening to this or just an investor in general, and they're somewhat new to this world, what advice would you give them on like best practices? Hey, you're looking for funds. You want to avoid the landmines. You want to avoid making really dumb mistakes. What kind of advice would you give them as a framework to how to think about these type of funds, the good and the bad?
A few warnings for advisors up front, because private credit has been the area attracting the most capital. Be mindful that don't buy yield, don't chase yield. Make sure you understand what the net return is, because a lot of the posted yields are going to be higher than your actual return experience. And I think when it comes to assessing some of these newer funds, most of the market doesn't even have a 3-year track record. So you're going to want to ask the same types of questions that gatekeepers at the wires ask, which is, have you run this strategy in an evergreen format before? What is your track record doing so? Because you can have a privileged institutional conversation and you can take a look at the longer private fund track record, but you're going to want to make sure that the strategy hasn't been diluted. So you want to ask, what's different about the private fund from this fund? What changes have you made? Appreciating the fact that there's going to be probably a portion of the portfolio in cash or cash equivalents to meet the quarterly redemptions. So that's what you want to understand is, how far off the mark from what they've done in the past. And I think that's true across a lot of different asset classes. And I think be careful with some of the public-private blends. Once again, ask what the expected return is going to be of that product, just so that you don't have the wrong expectation. I think it's probably a little easier for financial advisors to slot in dedicated private market strategies at this point. We hear from a lot of advisors that they're now using private credit or direct lending as a substitute for a high yield. They're using private equity for part of their total return oriented. Maybe it was public equities. So we're not seeing like separate alts baskets anymore. It's kind of getting weaved in. And so just make sure that it's going to deliver on the objective that you're using it for, over making sure your time horizon is appropriate, to Meb's point, because much of this doesn't come true in a 3-year time horizon. It might be 5, 7, or 12 years, depending on the asset class. So make sure you kind of think that through. And you're going to probably get overwhelmed because there's now 280 funds. So you can look to us as a resource. I think that there are more resources coming online to educate advisors, partly because adoption rates are still fairly low among investors. So the good news is there'll be more resources coming.
You dig around, you see an interval fund tracker, you see a few different places that talk about these types of funds, but it is a little sparse, I think. So good opportunity for XA. When people get in trouble, is it often mismatched expectations? And so thinking back to the last few years of people getting locked up, how rare is that? Is that pretty rare for that to happen as far as the fund company, the liquidity gates going into effect? Or is it just kind of regime market dependent, where if we have another 08, 09, you're going to see that everywhere? How do you think about that?
Recently, people have had experience where there have been gates, BREIT, Starwood REIT. Yeah, nobody likes to be gated, especially when there's an expectation. And then sometimes you have to wait multiple quarters to get liquidity. So that also doesn't feel good. So I think some of the fund sponsors overpromise on liquidity as opposed to sort of your idea and approach. There's a few firms. There's a firm out of Portland, Oregon called Variant. They're very thoughtful. They actually tell people, don't come into our fund unless you have at least a minimum of a 3-year hold period. So they set the right expectations on the front end, but they are unique. I don't know many other interval fund sponsors that do that. But the capital then for them is a lot stickier, right? And they can manage the ins and the outs better because they're in direct communication with a lot of the advisors. I think for RAs especially, firms like Cliffwater, firms like Variant are dedicated RA only. They're not selling the fund into the wires or into the independent broker-dealer channel. And that can matter. So maybe ask that question in terms of where is the fund available. The wires, there tends to be a lot of demand. And so the uptake can be very good from a fund sponsor's perspective. But the higher the velocity on the way in, the higher velocity on the way out, potentially. So it's something you have to keep in mind. RAs, it's not fast and easy on the way in, and it doesn't usually come out very quickly. So in that sense, the RA capital does tend to be a bit stickier for interval funds. But you want to know the company that you keep in terms of the fund that you're investing in. Some firms like PIMCO, for example, or BlackRock are multi-channel, all markets, which is fine because there's diversification in that. But you should at least ask the question in terms of who are you investing alongside?
I think that the biggest simple advice, and people don't often want to take this advice or do it because it is so simple, but it just requires a little work, is go read the prospectus, know what you own. And so many times we'll look at funds and see them run in a way where I say, there's no way that people that are allocating to this, if they knew XYZ, would continue to be an investor And it's not just private funds, it's public funds. We've seen it with ETFs, where we talked about one ad nauseum over the last couple of years. That was a giant fund and was regularly buying 10, 20% of the float of small cap stocks. And I said, there's no way anyone knows that they're doing this, because if they did, they would sell it tonight, like today. Like there's no scenario. And so I think a little bit's just being lazy, right? You know, reading the TLDR headline and not reading the actual, what is the fund going to do? And we even were saying this with BREIT and others. I said, look, the structure in and of itself is totally fine. In some ways, I think it's a feature, not a bug, if you know what you're getting into. If you buy it, assuming there's liquidity, and then get upset when there's not, that's on you, investor, right? Like you shouldn't, if it plays out the way that they said it would play out and you're upset, then I think clients also make sure your advisor knows. If you see a holding and say, or they're pitching something, say, okay, well, do you really understand this? And what is our liquidity? Because I think a lot of people skim over that part a little bit, or they think it won't happen to me.
I actually heard a sort of contrarian viewpoint from a wealth manager that I actually liked what he was saying, because he said with subscription documents, you have to have your client come in and sign the documents and they've got to flip through 50 pages. He's like, I like to make it painful on the way in, because then they know it's going to be somewhat painful and they got to wait on the way out. So he's managing his clients' expectations. And that's why he has very wealthy clients. He's going to keep them in private funds because he likes that setting of expectations appropriately. Now, interval funds, it makes the advisor's life a lot easier, but you still have to have that conversation with your client. So I think it is true that people skim over the liquidity piece of it, because there's a lot to explain here. So you can understand how it happens naturally. You got to explain the structure, the strategy, the fund terms. You got to do that in 5 minutes or less. So you can understand why liquidity is probably not top of that list, even though that's why I like the variant approach. They start with that, and maybe more people should.
As we look out the next 5-10 years, so take us out to 2030, what do you think we're going to be looking at when we see sort of this marketplace? More of the same, just growth? Any new channels that you think are going to be particularly interesting, et cetera? You mentioned the platform very briefly, things like Fundrise. Are those going to be ascended, or are they going to kind of be a secondary part of this? Give us the crystal ball, the Kim crystal ball.
Basically, it's alternatives everywhere, all at once, every channel, every product structure. So we're seeing this already with some of the model-driven asset allocation work, where we're seeing target date funds try to incorporate a 10% sleeve to private markets. We're having conversations with insurance providers about variable annuities. You've seen John Hancock and Lincoln and Jackson launch their own proprietary interval funds. So interval funds may be used as an ingredient or a piece in a larger model or retirement portfolio. So I think we're going to see it incorporated in different ways. I would say some of the early announcements are a little clunky, and that will get better integrated as we move forward. But the market's growing at a 30% compounded annual growth rate. So I do think that advisors are going to have a lot more choice. Funds are maturing, so many of the funds are going to hit their 5-year or their 10-year track record, which is helpful for decision making. But in 5-10 years, you're going to have triple the number of funds in the marketplace, right? It's going to be more like the acceleration of growth that we've seen in the active ETF part of the market. Different trend, but similar growth pattern that we're seeing. And right now, traditional mutual fund sponsors and ETF sponsors are actually a smaller part of the overall market. It's really the alt boutiques who are leading right now. But I think that'll change. We're also seeing other types of fund sponsors like the insurance firms that I mentioned. But a lot of RIAs are saying, hey, I'm going to launch a proprietary interval fund. I've got the demand, I've got the client relationship, and I know how to asset allocate. So we're also seeing Beacon Point as an example of that in the RIA space. So different types of fund sponsors entering the market, more model-driven portfolio sort of mixes that will use interval funds as part of what they're doing.
Bright future. It's going to be fun to watch. You look back on your career, what's been your most memorable investment? Anything come to mind?
My most memorable investment. So I invest in my proprietary funds. I like to have that alignment. And I tend to be more conservative, after spending 12 years at Nuveen building income-oriented products. So I'm not as much of a risk taker as I suppose my age should suggest, or to my kids' chagrin. So I'm heavily invested in private credit, specifically within the CLO debt, CLO equity part of the market. We have an expertise in that area. So the beauty of what I do in the consulting work is I get to meet a lot of very smart, very talented investment managers. I'm not a passive investor, so I like meeting smart, talented teams and then allocating my money in that way. And I do manage my own money for retirement. I don't have a wealth manager. I probably should have a wealth manager because, the benefit of the wealth manager is they keep you invested and they give you advice when somebody like myself is probably too busy running a business to be managing the money. But yes, so that's why I say all things private credit, I tend to focus on.
Bad news, you're going to get about 10 calls now that you just said it on the show that you need a wealth manager. Anyway, other than XA, tell us where the best place to find you guys, what you're doing, your research, your updates.
Well, follow me or follow XA Investments on LinkedIn because we actually post daily observations on the interval fund market. So if you want to get smart, we'll push it to you there. We also do a monthly market update for free. So you can sign up on XA Investments for that. And that way you can kind of track the growth of the overall interval and tender fund market.
Awesome. Kim, thanks so much for joining us today.
Yeah, thanks, Meb.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.